Hey there, hope you're well. The topic for today's video is to talk about the difference between accrual basis of accounting and cash basis of accounting. And you may have heard us talking about accrual basis of accounting in our week 1 topics. So one of the main purposes of accounting is to calculate the profit. The formula for profit is revenue minus expenses equals profit. But the question is, when should we record the revenue? Because sometimes we earn the revenue and get money at the same time, but sometimes we collect the cash in advance, and sometimes we give the service to the customer and we have to wait a few weeks to collect the cash from the customer. So the question is, when should we record revenue? And the same question with expenses. When should we record expenses? Because again, sometimes when you pay for the expense is not the same time that you use that expense. Well, there are actually two different approaches that you could use as to when you record revenues and expenses. So the first approach is called the cash basis of accounting. So revenues are recorded when cash is received and expenses are recorded when cash is paid. So this would be the kind of method that a small business would use. A small business may be with one owner and the owner's running the business themselves. Anytime they receive cash from the customer, they record that as revenue, and anytime they pay cash, they'll record that as an expense. So for a small business, this is okay. But if you think about the larger companies that have $1 billion in assets spread out all over the world, and they might have transactions that spread over many years. They could spread over 3 or 4 years. They're going to need something a little bit more comprehensive than just the cash basis. So that's why we have the accrual basis of accounting. Now, in this method, the revenues are recorded when they are earned. So what does earned mean? Earned is when you give the service to the customer or you sell the product. It doesn't matter when you collect the cash. Expenses are recorded when they are incurred. I think of that as when they happen or when those expenses are used. So again, it doesn't matter when the cash is paid. What matters is, when did you use that item? So this method follows the principles that we talked about in week 1. So the revenue recognition principle says that a business should record revenue when it is earned. And the matching principle relates to recording expenses. And this principle says that expenses should be recorded when they are used to generate revenue. Why? Because what you want to do is match the revenue you earned from your customer. You want to match the cost to get that revenue. So accrual accounting gives a more complete picture of business activities, and it's required by GAAP, which is generally accepted accounting principles. So this means all public companies are going to use the accrual basis method. So any company where you get the annual report off their website, they will be using accrual basis accounting. Who would use cash basis? Just a small business who isn't publishing financial statements for anyone. They would use the cash basis method. Now, when you're doing accrual basis accounting, if you'd like to know more about the cash in the business, then you can go to the cash flow statement and you will learn about this next semester. All right, so let's look at 2 examples to compare the difference between cash and accrual basis. In 2019, a business received $7,000 cash for services to be performed in 2020. So how would this be recorded using cash basis? In 2019, because you received cash, then this would be your revenue, $7,000. In 2020, there's nothing to record. All right, what about in accrual basis? So remember, in accrual basis, we're thinking about when did we earn the revenue. So in 2019, the business received the cash in advance from the customer. They have not provided the services yet. So in accrual basis accounting, this is what we call unearned revenue. This is a liability for the business. So the business would show that they've received the cash and now they owe the services to the customer. Now, in 2020, when they perform the service for the customer, that means the revenue is earned. Then we will record the revenue of $7,000. In 2020, the unearned revenue would be cancelled and you would record the revenue. So what you can see in both methods, we record revenue, $7,000, but you can see that there is a timing difference. Cash basis records the revenue earlier, the year earlier than the accrual basis. So this means when you're calculating the profit, if you were comparing the two methods, you would notice a difference in profit in each year. Okay, next example. In 2019, a business paid $9,000 for rent for the first 6 months of 2020. So how would this be recorded in cash basis? So remember, in cash basis, if you pay cash, that will be your expense. So the cash is paid in 2019 and that will be our expense, $9,000. What happens in 2020? For cash basis, nothing. Let's have a look in accrual basis. So in 2019, have you used that expense? Have you incurred the expense? The answer is no, because you're going to use that rental property in 2020. It's not used at all yet. So when you have paid for the rent for 6 months, this is actually what we would call a prepaid rent. It's an asset. You've paid the rent, so now you have a future benefit. You can use that property for the next 6 months. So in 2019, if you're using accrual basis, you would show an asset for $9,000. Now, in 2020, you will then use the property. Your prepaid rent will decrease down to 0, and this is when you will record rent expense of $9,000. So again, it's a timing difference. Cash basis records the expense in 2019, but accrual basis records the expense in 2020.